Thank you so much for inviting us here and participating in this session. We hope that we can engage all of you in this still post-lunch hour. What we basically propose to do in the next hour and some time is really to engage two different groups which are represented on the dais here. Four of us on the team, two on my left and two on my right, are founders and CEOs of their own businesses. And they have all gone through the process of raising money and building businesses. So we thought we will get their experiences on both raising money as well as managing to work with investors and how to build the business. And Hemu and I, who are right in the middle, are representing the investor side of the equation. And we will try and bring out the contrast between some of our perspectives. And we have put together a few specific areas that we would like to focus on. Hemu can give you a little more color into that, and then we'll dive into the session.
Just to give a perspective of what the session is going to look like, we're really trying to focus on what worked and what didn't work for these investee companies. What are the perspectives that an investor looks for, and what are the challenges really of fundraising? And then there is a fair amount of interest and attention that we want to give on the post-investment part, which is post the honeymoon period of fundraising. And last but not the least, really, how do you make the investor happy with the appropriate exit? There is enough time for Q&A at the end of it, so I'm sure those of you who have questions will come back to that. So I think, just to kick off from where Kanwal said, and I'd like to start with Kiran, just in terms of his journey with Cartizone. When you look at, this whole question of funding and receiving funding, you had a fairly interesting journey over the last many years. What has worked and what has not worked? And it may be useful to just step back a bit and take us through that journey.
Sure. I'm wearing two hats here. I've been a venture capitalist earlier in my career and now an entrepreneur. What has worked for us, I think, some of the things that are important for an entrepreneur to present to a VC, I feel. One is, I think, whatever, a business venture that you want to start, I think clearly you need to address a large business opportunity. You are not really looking at a very small niche market segment to address. Because I think even if you own 100% of that niche market segment, I think if it's not going to be large, I think the private equity or venture capital investors will find it difficult to exit from that investment unless you find a strategic buyer for that business. So typically they would like to see a business where you can grow to a significant scale within a certain defined time limit. Second thing is, when I invested, for example, most of my 20 years in venture capital, I focused on primarily early stage investing, where typically you invest in a two-man and a dog kind of a situation, right? So I think what was important for me was that I think the entrepreneur and the team that he would have put together, I think have the ability, first of all, understanding of that business. They understand the challenges and the issues involved. They clearly articulated how to scale this business. So the business plan clearly articulates that. And I think they show an adaptability to a market which is always changing, right? Businesses never remain static. They're always dynamic. And therefore, in the management team, I always looked at, there are certain traits in the team that showed me that, they have an adaptability to change. So nimble-footedness in some ways. So that was the second. And the third is, of course, whatever you're offering, you have to have a strong differentiation. Food is one of the low entry barrier businesses. Anybody can start a food business. And therefore, I think in food, the mortality is also very high. How do you differentiate your business in a very crowded market like food, for example? And that was something that we, planned right from day one when we started Cartizone. I mean, Cartizone, just to give an background of Cartizone, we are one of the early players in the quick service restaurant business using Indian foods. There are a lot more concepts that have come into food in India, which are international giants. But we are one of the early players who are defining the Indian food QSR. So three things that were very important that worked for me, both as a VC as well as an entrepreneur, is I think one is to have the right kind of team, right kind of product that has a strong differentiation in the marketplace, and a business opportunity that is where you can scale the business considerably.
Samir, you want to add the operating perspective to this whole thing of what works?
So, before my current role, which is I'm president of the National Restaurant Association, and I've also started up very recently a consulting company for hospitality and retail. I was for the last 6 years a co-investor with a PE fund called Navis Capital, and also the operating CEO of Nirula's. So from an operating perspective, I think it's very important, in a very simple nutshell, Albert, to be on the same page as your investor. Choose an investor who you have, besides the numbers and the agreements, you have a rapport with, you are on the same wavelength. And inshallah, you have to make it work because you see so much of your damn investors that you don't have a choice, that you have a good actual relationship with your partner who's on the investee side. So, and I think from an operating perspective, I've been involved in helping, Sanjay Narang, who used to run, Gordon House, Jazz by the Bay, Mars, and Trails and Restaurants, sell a stake to Navis. And I was co-invested with Navis in Nirula. So I've done the buy and the sell. But I think also there has to be a lot of realism. So often I'm seeing and I've heard and I've seen, business plans and 5-year plans, and they're made too early in the investment. So yeah, if you're making a business plan with a promoter who's staying on, and be realistic, so don't be over ambitious. It's better to be realistic and put in an extra couple of percentage of the sales for marketing. It's better to be realistic and put in buffer for the extra capex for the outlet growth as you're building for 5 years. So that when you look at that result at the end of the year, you're not looking at, versus the 5-year, which was made in 3 years ago. And at the end of I was a co-investor for 6 years. After what? We made a business 5-year plan after, they made one before the investment, which was a mistake. Then we made a fresh one after 1.5 years. And then a year later, we tossed it out. And we moved to annual operating plans. And saying that the market was changing so much, there was the financial crash, the Bombay blast. There was action happening every, 6 months. So we actually, be realistic. Be realistic in terms of, as a promoter, what you commit. Whether it's in terms of rollouts, whether it's in terms of sales growth, same-store sales growth, or in terms of cost optimization. So that then, therefore, it's better to over-deliver, over-perform and under-commit than the vice versa.
Kanwal, you want to take the investors' view on what worked and what didn't?
So I think one of the interesting dilemmas for us as early-stage investors is this question gets asked all the time, saying, why are there so few investors and why are people not investing in quote-unquote traditional businesses, and retail and food services being one of them. And I'm assuming that, the fact that all of you are sitting here, there is some at least academic interest in the space, and hopefully some budding entrepreneurs also sitting in the audience here. One of the biggest issues with the whole, quote-unquote traditional or brick and mortar businesses is that it takes a long time to scale. And the time horizon of investors typically, at best 5 years, 7 years, you're looking for an exit. And that alignment of the business model with that kind of an exit horizon is really the biggest issue, apart from the complexity, as Kiran rightly mentioned, of execution, of getting a lot of arrows aligned all in the same direction. So what we look for is just a takeoff on what Kiran mentioned, is somebody who has both the nimble-footedness to adapt to the changing environment, but also the foundational capability to build the platform of scale. And these are, at one level, slightly contradictory to each other. So you have to, find either an individual who represents both, or maybe a combination of founders who can bring in the two perspectives. Because at one level, you're, worried about how are you going to pay salaries next month? How are you going to bootstrap the business? And at another level, you're thinking about processes and systems and getting sure that you are not going to be building a 5-store or a 10-store operation, and you're trying to at least lay the foundation for a 300, 500-store kind of a business model. So I think that is one very important characteristic. There's almost schizophrenic personality that one would look for. And second critical thing is that the most important thing for us as investors, and we have done a few investments in this space, is really understanding the absolutely finest detail of how a unit model will work. And this is something which all of you guys from the retail world understand and imbibe very deeply. But as an entrepreneur, this is almost the make or break of a business. Because if the detail of how you're going to make one unit work, so focusing on getting that model right, and then figuring out how to scale that model. I mean, we love that kind of a concept. So, companies that we have invested in, our confidence is that the model is well understood. And how do you build on top of that, and so on and so forth. So I think the good news is that there is appetite. Interestingly, there is more and more money which is looking at younger and younger companies. So new seed funds have come into the system. People like us have started investing in early stage quote unquote, brick and mortar businesses. A lot of angel money is available. But as entrepreneurs, what we really want to see is both the ability to get the model right and add everything else that Kiran said, scalable, something which can really build a large business and so on. And second is the mindset of an entrepreneur. A lot of very seasoned professionals who turn entrepreneurs are not able to adapt to that requirement of what typically an entrepreneur is required. And that's the trigger which we are trying to assess pretty much as we evaluate a new investment. So just some practical tips I thought I'll share from the investor's perspective.
Just to add our investor perspective to what Kanwal has said, for us actually the consumer proposition is actually really the starting point. For example, Kiran's concept of Kati zone. Clearly, the concept of a Kati roll is probably as old as the Mughal era. But the fact that somebody thought of packaging it and presenting it in a QSR proposition is obviously something which makes it very exciting. So for us, the core consumer proposition is really the starting point of the entire business model. Because if the proposition is known, it is familiar, and yet innovative, it makes it attractive and yet less risky. The other thing is, at least that for us that is very important, and I'm sure Kanwal will agree, is the entrepreneur himself or herself. Many times, you get many proposals almost every day. And literally in 5 minutes, you can make out the amount of homework, the amount of research, the amount of preparation that the promoter has done or not done. And it's sad sometimes that, you can see a proposition which the idea is interesting, but because of a lack of homework or preparation, you find that, hey, I don't want to put money with this kind of an entrepreneur who hasn't taken the trouble to do homework and, really cross the T's and dot the I's, just in terms of the proposition. So for us, those are two perspectives in addition to, to what Kanwal spoke of. So taking a cue from that, and, I'll ask Gaurav to probably share his perspective, having received money from Helion. What would you say are your perspectives, and your experience as you put together the business plan? What were the things that, Kanwal provoked you or supported you on? And what was it just in terms of the preparation of the model that you were able to do to make it work?
See, one thing which I want to tell everybody right in the beginning is we started Maskalandar a few years back. And me and the other co-founder, Pallavi, both were not from the QSR or the hospitality industry. So what really worked or not worked for us is kind of an oxymoron because we are not from the industry, we could think very differently. So we could think of scaling a fresh food concept, which is practically absent in the industry today, or very few players are now coming up. What also did not work is the same thing. We are not from the industry, so we did not have the experience. So some of the mistakes that we did, we probably wouldn't have done if we were from the industry. What worked was extreme passion when we started this, and we started this because we wanted to address a core problem. When we were working as IT professionals, we used to always hunt for the kind of food that we want at the price point, at the convenience, neighborhood location, which we can eat on an everyday basis, which is clean, hygienic, affordable. And then we put in all the sweat, all the money that we had saved for 5-7 years of our corporate careers into the business, a lot of hard work. And at some stage, we thought that now we are ready for pitching to the VCs. Thankfully so, we got funded. We got funded twice. Once the money came in, I think what really changed was the thought of the scale. How do we now scale it up? So managing 3 stores, managing 5 stores is a very different phenomena from thinking of managing 30 stores or 50 stores, 100 stores. So that is one of the things which really changed for us. The second is the entire approach, how we look at the business. Because as we are scaling, this is a QSR Indian food that we are doing today. Nobody or very few players have done it. So at every stage, we get new challenges. And hence, no matter we make the business plans and we give it to the VCs, and we sit in the board meetings and get them cleared also, but we are ourselves scrambling with those new challenges which come every now and then. And then, we revisit the business plan and say, look, this is not work. So the other thing which I want to bring up is, it's extremely important that you have a wonderful chemistry with the person who has invested in you. He understands the complexity of brick and mortar business. He understands, as Kamal was also mentioning, that it takes longer time to scale. So if you take any of the larger chains like Starbucks or McDonald's or KFCs, the first 30 years, probably they have not done as many stores that they have done in the last 10 years. So it is a different trajectory altogether that so the VC has to be ready for that kind of thing. And these things become dynamic on a day-to-day basis. So that thought process, that scaling, all that has changed since we got the money.
Jay, you have worn almost 3 hats in 3 different ways. Not necessarily limited to the business plan, but from your experience, what is it that worked in getting the funding, and what is it that in many cases resulted in you tripping while the funding was being arranged?
I think, firstly, we went the classic way. We didn't go to the venture funds right at the beginning. We went first to the FFA, that is the Family, Friends and Associates. In fact, my wife's brother was the original angel investor. He invested 6 lakhs and he got, I think, a return of over 100, 125 crores. So a lot of money. After he invested the second round of funding also, but we were naive those days, so there was no valuation. It was a partnership account, so it was just money going into his account. So he was getting more money and we were getting diluted more without valuation. Anyway, it didn't matter because nothing mattered except the business and the passion of the business. Then we went to the banks. And we went to the banks not for doing interiors and fancy chandeliers and all that. We went to the banks to buy property. And we leveraged this property to buy another property. That's the way we built our business. So we used the banks. And fourthly, we used all our suppliers. As our business grew, we had huge negative working capitals, and we used that to build. Now came the crunch of, it was a family business, so the brother was more and more in the business, what to do. So we looked at a venture partner. What advice I give you here is, get a good advisor and pay him a decent amount of money. A lot of advisors say, I'll give you free. Don't do that, because then it'll become his information memorandum, it'll become his business plan. You have to sit, pay him money which hurts you, so that every week you sit and introspect with him. You get focused. And now you should not get focused at this time only on your business plan and your budget. You should now be focused on your business. Clean up your business. Get things right. Because all these things take a couple of years. And don't get disheartened when money doesn't come. Because advisors say money is coming, this guy is queuing up. All these things are happening. You focus only on your business, only on your employees, only on your customers. Everything else will follow. Trust me. You deliver on the brand day in and day out. And scale up the way you want to do. Don't be worried if the money does not come. It will come from other source. Finally, you will come to a stage where you might have venture capital, you might have a strategic partner, or you might even go for bank funding once again. Again, don't get carried away. Look at all three things, because according to me, the best funding today is bank debt, even though I work now with a venture capital fund, as I work on the other side. The best funding is bank funding. Pledge your house, pledge your last shirt on your business if you believe in it. I think that's the way to go.
Excellent. I think that really says it very well. But Kanwal, I want to take a cue from what Jay said, and I think you may want to add to that. Particularly, at least my view on companies who, look at different avenues of funding, debt versus equity. I have a personal view on what ratio is optimal at what point in time. But any thoughts you want to, suggest, particularly for people who are starting out early on in terms of debt versus equity? And
so I think the first challenge is that debt is not available. So I think the point Jay made is absolutely valid, that if you have access to debt and you have the ability to service the debt, because debt comes at a tangible cost. Venture money is not free money. It has probably a higher cost to pay. But at least the upfront cost of debt is very visible, and sometimes venture money looks like easy money to begin with. I mean, the noose tightens as you go along. So I would say that if there is an opportunity to access debt, then I would agree with Jay to a great extent that having a judicious mix of equity and debt is probably the best way to go, because both have different costs, both tangible as well as hidden and intangible costs. And there is a certain value that debt can provide, especially in businesses like these, where you can very easily see how that money is going to get used and how the returns are going to come. I mean, we also invest in a lot of technology companies, so I would certainly not advise anyone to take debt for an e-commerce business, for example, because these are much further out kind of break-even models. So to answer your question, I would certainly say that I would probably go more for a balance between debt and equity rather than one or the other. What ratio is very dependent on individual situations. I think one small point I want to make here as we talk about funding and the opportunity. I think the biggest thing that we are starting to see in the last few years, last 5-7 years, is the access to money, especially equity money from not just VCs but the other ecosystem, is prompting a lot of people to turn entrepreneurs with a time horizon of saying, 5 years, I can make several $1 million. So this get rich quick kind of a formula, that is not, I think that is never going to work. So the slow and steady way, I think all the people sitting on the dais are going to tell you the same thing. Start with the passion, start with the belief that you want to really build a business that you believe in. And even if you don't get VC funding, I mean, that's not the reason to do the business in the first place. So even if there is friends and family money, even if there is some other, small source of funding and you have to keep working at it, it is still worth it, because in a certain point of time, the business reaches a stage where, in fact, there's a saying which says that the time when VCs want to invest is when you don't need the money. So that's really at least the mindset to go with. And we find a lot of people come to us saying, I have a plan. I am not going to start this business till I get a VC funding. I mean, we would rarely ever do an investment like that. We are saying, put your skin in the game. Write a check for 10 lakhs. Start your business. At least that gives us the confidence that you're doing this out of passion and not because somebody else is writing a check for you, and if it doesn't work, so what, I'll go and do something else. So that is my most important learning in the last 10 years in the venture industry, is get rich quick is not going to work. And don't wait for a term sheet before you start a business, because again, that's going to be almost like a rare possibility in my view.
Absolutely. And I want to take one important phrase for all of those here who want to or are in the process of raising money. Skin in the game. I think that is a phrase which I'm sure all of you have heard and will hear again and again. Typically, skin in the game, as you all know, means the amount of money that you've put in, right? How much of your own skin will get torn off if you sink. we actually add one more dimension to that, and that is what we'll call the credibility or the emotional skin in the game. Many times we find, I think like Kanwal rightly said, that, we have a great idea, we think we can flog it very quickly to a VC, and once the VC money comes in, then, our journey really pretty much ends. And we try to look for what is the entrepreneur's medium and longer term commitment to the project. Because we don't want to look at people who are, going to look for a quick buck, as you said. And really how much of their own credibility, their own image is at stake in the longer term in that business or in that concept. Kiran, I've known Kiran for a long time, and he's had, I would say, if you don't mind my saying so, a very, very challenging journey over many years to get to where he is. And it's, now of course you're at a takeoff stage and so on. But we like entrepreneurs like that. We like people, of course, who've put in their own money, but also put their own credibility at stake. For us, that's a very important part. So that's, I think, the first bucket really around, what worked, what didn't work. I want to take this a little bit further to, and maybe we'll start again with Kiran. Kiran, what would you say, particularly when you're making a business plan, what are the challenges that you need to look at when you put together a business plan? What are the key elements of it? What is it that an entrepreneur really needs to highlight? Because you could have a 200-page business plan, which frankly I would never read. But what would you say are the highlights or the key aspects that need to come in?
So one of the key things I mentioned was the people behind the venture. So I think one of the things that was very important for me is to have the right kind of team in place before I could go to a VC. And incidentally, when I started Cartizone in 2004, there were no VCs around who would have put money in a non-tech business that time. So I bootstrapped for 3 years, and more than a skin I had, skin and more I had in the game. So anyway, so one is team. Second thing is, because I have been a VC for 20 years, I think what was more important for me was whether there was VC money or not. I think if I had started this business primarily to build something significant, highly scalable business model, right? So demonstrate the scalability of the business model was the key thing for me. So therefore, I think we had to invest considerable amount of money and time and effort in demonstrating that scalability. For example, our business works on a hub and spoke kind of a concept, So we have a central manufacturing that supplies all the ingredients to a large network of stores, retail stores. So we needed to understand, for example, so there is a frozen supply chain. I think in the morning session, there was a discussion about the cold chains not having well developed. So the cost of logistics in India is pretty high. So how do you deliver food from one location to different retail stores and still meet the value for money offering? Because we are in a segment where I think we have to offer a value for money food. So third thing is we didn't want to run the empire as a monolithic company. So we had to we planned right from day one, go through a franchising model, which means there's another partner who has to make money in the process. So the our franchisee has to make money. We have to make money, including, all these high costs of logistics and all. So we had to understand those issues. Third thing was, in India, I think, again, there was a talk in the morning about real estate costs being very high. The manpower turnover is very high. So finding the right kind of retail formats, that were appropriate and would deliver the promises that we were making to the franchisees. So, we looked at both the dine-in formats and the takeaway formats. And one of the good things for us is, the way we have designed our venture is that our food is such an easy to-go kind of a product. You can consume it on the move, you can consume it in a bus, taxi, flight, whatever. So therefore we can be ubiquitous kind of a business. And, so we demonstrated all that. So finding the smallest, for example, today we have the smallest format, which is a kiosk format, which is like a cookie cutter format, which is an 8 feet by 8 feet, from which we can deliver, a food. And therefore it breaks even at low volumes. Only 2 or 3 people are required to manage the store. So you eliminate or substantially reduce the real estate risk and the manpower risk. So all this, that becomes the demonstration of a scalability. Was very important for us. So those are the pains that we went through in the first 6 years. And I think, like Gaurav said, food businesses are something, in our business, for example, it takes far more time to grow from 0 to 20 stores. Growing from 20 to 200 is much easier. So what we have done in the last 6 years, essentially, to give an analogy, build the foundation of a 100-story skyscraper. So that's what the pain was.
Great. And Samir, you may want to amplify, basically receiving money comes with huge challenges and, of course, responsibilities. But staying with the challenges at this stage, from your experience, what are the typical, I would say, obstacles that one finds, as you are
Post-receiving?
No, before you receive the money. Okay. Just in terms
of...
Sure.
I'll give some practical examples. While I was at Navis and I did engage with a bunch of what I thought were very good potential investors, both strategic and financial. So some of the challenges is, of course, as a brand like Nirulas, there's no challenge in proof of concept or anything like that. But it's a challenge as to, okay, with the next investor who comes in and pays X and cashes out the two people there and then puts in Y, right, over the next 5 years. There was a very clear 5-year business plan I had actually made. And what is the IRR on that Y? And really proving to the investor, and this is more like a second stage, really, is that, hey, there is a game for you. So you can, and that's important for people like, Kiran and Gaurav who are now, at that second stage. One has got second, one perhaps, when we're looking at second stage. So there is always an investor, whether it's an HNI, angel, VC, PE, let me tell you, they all look at IRR. Some of them look at it microscopically, someone look at it more macroly, but they all look at IRR. They all have their horizons, ranging with angels as less as 3 years. And you ought to have, and this is the topic we're coming to later, but you have to have a very clearly defined exit. So if you're looking at getting funding and you're early stage, you're startup, you're growing, you've got to be able to tell the investor that here's the plan and this is how, because not everyone can go IPO, right? You only need a certain scale and size of business to be able to IPO. So if you're not going to be able to IPO, you have to have a clear understanding when you're fundraising as how you're going to give an exit option to the investor. I think that's very, very important. That is a challenge. And you have to give an exit option, obviously not guaranteed, but where the person sees, okay, hey, this is possible. In 3 to 5 years, if I want to exit and IPO is not happening, I can exit and I will get a return on my investment, which meets my internal IRR norms, whatever they might be. So I think, then of course, I think one other key challenge which I saw and faced was that, so if you're a regional brand and you're trying to go national, and that was the case with Nirulas. We took it from 35 outlets in 2 cities to 85 in 8, but pretty much north and central till I left. The way I had signed up people in other parts, is that how are you going to succeed with your brand and your concept, and this is applicable to a retailer as much as to a beauty parlor or anything, anyone in the retail business, across India. Because there is a lot of local competition. There are very strong local players in every segment. So for Kiran, Nizam's Kathis is a very strong player in the north, right? And you have to really, proving that to the investor is a challenge. When you're in 7 cities and 6 of them are North India, then saying, hey, I am going to rock in Bangalore, Hyderabad, Chennai, and I have a franchisee, and I have location set up is fine. But actually convincing the investor that you will be able to successfully expand nationally and keep those, the brand will successfully penetrate and enter new parts of India. I think that's a challenge when you're a regional player trying to go expansion. That was a couple of the challenges that I faced.
Great. Taking a cue from what Samir said, I think I just want to ask this question possibly to Jay and come back to Gaurav. When you look at an investor, and now of course you sit on this side, and so it's probably applicable what you look for in an investee. What are the key qualities that you look for? I think it's a given, at least we believe, that an investor-investee relationship is a marriage. So there is a long-term stake. But just in terms of what are the key things to look for, and what are the things, more importantly, to make sure do not exist in that relationship?
I think it's a very easy answer. We chose the Tatas. So I think the Tatas epitomizes everything which you should look for in an investor. So we had a venture option, we had a strategic option, we had a bank option. We went for the Tata option because we wanted to do other things in life. Because there is a life beyond your business. Please understand that. And we wanted to be in that life. So that's because if you work with a venture partner, you have to work on a treadmill for the rest of your life because he will make you work non-stop. So if you work with a strategic partner, he wants you out, okay? So he wants you out, so we wanted to party, so it suited us fine. So I think we chose the Tatas because they were the best thing to happen to us.
So I think there is, he's absolutely right. And to give you the 180-degree perspective from the investor, there are two challenges that we face when we are looking at entrepreneurs. One is a very, very unique Indian phenomena, which is that the entrepreneur is not willing to let go of the CEO's seat ever. So it's a strange situation that you have to back somebody who has all the virtues of what an entrepreneur should be: passion, bootstrap, willingness to take risk, nimble-footed. But the minute the business reaches a stage where now it needs scale, process, foundation, the boring day-to-day stuff, he still wants to run it. And it's impossible to get another professional who might be the right person for the job at that point of time unless you have a huge conflict and all kinds of things happen, which in any case is a lose-lose for both sides. So I think one of the biggest issues as investors is this aspect of almost like built to last kind of entrepreneur that we have to choose, who is great at starting businesses and great at scaling businesses. And that's a very rare combination to find in one individual. The second challenge, to Jay's point, is the longevity or the sustenance of the entrepreneur. Like I said in the beginning, if you're starting a business, please think 10 years and not 5, maybe 20. But what we start finding in India, and I've been doing this for over 12 years now, is after 5 years and having worked hard and now there's a VC already invested and all, suddenly the entrepreneur starts feeling fatigue or starts feeling, how do I, get some money out? How do I now, start creating some wealth for myself and so on and so forth.
Buy a Mercedes.
Maybe not Mercedes. Audi is the new one. So I think the challenge that we find is that in India, the goal set for an entrepreneur, and I'm generalizing it a little bit, so pardon my license here, is you say, if I make a couple of $1 million, I am happy, 10 crores in the bank, now I can go and party. And you made a lot more money, so I will not take that example. But, suddenly as an investor, if you have come in with a certain value proposition, you have invested at a valuation which is higher than the par value of the company, and you expect a return, but the expectation of the founder is that, listen, I am ready to sell the company at a price which is, gives me a lot of return, and lot return is, let's say, a couple of $1 million. How do you manage that process? And therefore, how do you, goal set yourself for the next 5 or 7 years? So it's a very interesting dichotomy that at one level, you're looking for somebody who can last the full race. On the other hand, that that person may not be the right guy to last the full race. So that's another schizophrenia that as investors we face all the time. And believe me, we still don't have a good answer, but we keep trying to find optimal solutions for it.
So before I come to Gaurav, I'll just add a little bit to what Kanwal said. And this is something that you may want to consider if any of you are raising money or already have raised money. At least I like to look at this as in many ways a marriage, right? And in the courtship days, very often you find everybody saying, yeah, don't worry, we'll do this, we'll do that. We don't mind an exit. Our return expectation is only so much and so on. And then once, the agreement is done, that's when, after, I think Jai was talking the honeymoon period earlier when we were talking, that after that, that's when, the real chips start getting laid on the table. And before you actually sign the term sheet, it may be worthwhile to really iron out a lot of these issues, particularly the sensitive clauses. All of you who are following Indian business, definitely in the lifestyle space, there are well-known brands who have taken money, the relationships have broken down, and today they're in court. So what has happened? Eventually the business has collapsed. So who won? Nobody won. Even the entrepreneur, let me tell you, in that situation, gets left with nothing. So before you actually get to signing the agreement and receiving the money, yes, it is attractive to get a check, not a check, nobody gives a check of 3, 5, $10 million. But everybody, it'll be worthwhile for you to really spend time, even if need be, writing out what are the key clauses or what are the key parts of your destiny, if I was to call it that, before taking the money. Because if you believe in your concept, as you know, I'm sure both of you did, you will find an investor. There is enough money out there. And eventually, don't forget, as investors, we also want good deals. We also need good companies to invest in. So if you are able to do that homework before taking the money, you'll have less grief and less financial loss later on. So Gaurav, just to sort of take a cue from where Kanwal left off, how do you see this whole choice of an investor panning out? And what have been your experiences, good and bad? And feel free to, take pot shots at Kanwal as you think fit. Or we can send him out for a while.
We raised money twice. We have two institutional investors on board, Footprint Ventures and Helion. And every time we raised money, we saw the people behind the money as to who's the person who's coming on board. And, no matter we get into the discussions regarding valuations, the amount of money that we take and the business planning and all, but really want to make sure the person who's coming on board is probably as passionate about the business as you are. He believes in the dream as much as you do. And he will probably bring in more value than the money. And believe me, that is more important for the business. Today, I have had experiences twice that is of incredible value of the other things that the investor brings onto the table. So in both the instances, I think right from sorting out the business processes to framing the business plan, to recruiting the right team, to making some of the strategic decisions, one, whether the investor is passionate and driven to make those decisions, and second, whether he has the capability to make that decision. And I think both the times we have, apart from the valuation and the financial returns, I think we have given it more value than the money itself. And I think I would recommend to every entrepreneur that that is the right way to go. Because end of the day, you will discuss each and every aspect of your business with the investor, or at least the investor would like to discuss with you. And if he is not on the same page, and if he is not as passionate, I'm sure you are in a very difficult situation.
I just wanted to add to this. So I think to add and to agree, but to add, so you've got to look at an investor not just for the check and the exit period and the standard stuff. Well, not standard, but the stuff you all look at. But as an entrepreneur, if you're already in business, will know that, okay, these are my pain areas. And if you're an honest entrepreneur, you will all have pain areas. There would be no business here entrepreneur who runs any organization of any size who says they're 100% optimized across every department, every vertical, and every area. So there are always areas of opportunity. So you should be looking and saying, hey, as we grow for the next 5 years and you know what the 5-year plan is, I have these current areas of opportunity and I have these areas where I know I'm going to need help. And does this investor, or the panel of 3 investors if you shortlisted, which of those investors has the capability in their organization, the farsightedness to invest in a capability if required, to bring you that external skill set and bring that value onto your board or to your business, which helps you achieve that eventual common goal of scaling up profitable growth. And there are definitely areas of opportunity. And, that was something where I found that we had with Navis and I a great partnership because they owned 6 F&B restaurant companies across 4 countries. So, we wanted to do a lean manufacturing project at the Nirula's commissary. And they sent in an expert who spent like 2 months helping evaluate, scope the project, meet the potential partners to do the project, choose, and actually come in and look at the execution. And it gave great results. It gave 4x of what we paid the consultant in the first year. So, but that external expertise of someone who's done lean manufacturing, so again, I'm just giving you a specific example, but there are always opportunity areas. And yes, there are lots of great investors out there who will either have that capability in-house or who will say, what the hell, it's a good company, I'm going to invest in a third-party consultant or someone to add value to my investee company.
Jay, I want to just shift gears a little bit, and particularly at an early stage in this whole funding cycle, I don't think the entrepreneur really thinks too much about the exit. And as you all know, for an investor, the exit is, when it all comes true, right? What are some of the tips that you may want to give to this group that in terms of planning for the exit, it's clearly too far down the road for most people to think, because you're really thinking, hey, I need to get the money first. But what were some of the thoughts that you had at that time, or you think, this group needs to look at?
I think the starting point is, it's paradoxical, but you never talk about your exit to the investor right from the beginning. You never talk about your exit, even though he wants you out after some time because he thinks you're not the MBA, you're not the, all those things. You don't have any of the things which a venture guy wants, except that you know how to make money. So he wants you out at some time because you don't have the qualifications. So I would say exits, we strategize exits like this. What are the ways of exit? You are a small business. Don't get disheartened if it's a small business. Small businesses can be sold to other small businesses, or you can buy another big business. So that's one way of exit, right? Because your venture fund, the moment you give him exciting stories, he's willing to back it, he'll bring other people to back it. So think laterally all the time. So that is one way of exiting. Easiest way of exiting is selling your business to somebody else. So early stage investments either close down and wither away, or they get sold to somebody else. That's one way. The organic expansion and your inorganic expansion. The second is, don't stop thinking. Bring in new ideas, follow the trends, and you will come across big ideas. Practically every year you'll have one big idea. And bring your employees into your business all the time. Let them also think tank. Don't have outsiders only doing the thinking. Your employees have to think along with you. And ideas will come, trust me, ideas come from the employees. Good employees, good team, give good ideas. So think of other ideas, how to allow the exit. The third is keep building your brand. Even if it's a small brand, like I'm seeing a lot of passion here with Maskalandar and Kati Zone. They're very passionate about their brands. Just keep, because at the end of the day, brand gives you exit. So I think if you look at it for early stage investments, it's strategic thinking and brand building. This will give you exits.
One question which, I'd like to come back to both Gaurav and Kiran, at least as an investor, and I'm sure Kanwal will back me on this. One of the key attribute set that we look for is, values, ethics, a willingness to invest on good governance, very basic, what I would call core values. I think we all know that we should talk about them, but it'll be useful for you to just share some of the things you've done to implement, good governance, basic environmental friendly policies and so on.
Yeah, I think that's a good point. And let me start from the fact that a lot of people think that they can just go around and raise money and they don't get the basics right, which is they don't have a clean company. And what do I mean by a clean company is that they don't get it registered properly. It's running as a partnership. Your dad is the CFO, and you have hired your best friend as the marketing officer, or probably your sister-in-law as the marketing officer. Yeah, so those kind of things don't work with investors. So I think first and foremost is that you get the basics right. You have a proper company, which is a legal entity, and you make sure that you fulfill all these statutory norms. So as you scale, there will be other challenges. So over a period of time, you will find that all your systems, processes, your corporate governance, everything is in place. And I think when an investor invests, one of the processes before the investment is the due diligence exercise. And many of the companies, I am come across have failed at this stage in which they don't pass through the due diligence exercise, which means that they have not fulfilled the norms properly. And at least I am aware, and Kamal and Himu can add on to that, that none of the VC companies will invest in a company which has failed this exercise. So if we get these basics right, then there is a chance of investment. Otherwise, there is definitely no chance of investment. As you grow, things become harder. For us, we were first in one state, now we are in 4 states. Going forward, it would be probably some stage multiple countries. So the corporate governance, the legal statutory norms also become more stricter, wider. So you'll have to probably hire. So one of the things that we did is to get professionals on board. So very recently we deployed an agency who's taking care of all these statutory norms, so at least all those basics are in place. Then some of the things which you don't, so that's one of the things on the statutory part. So some of the things that when we talk about pollution or we talk about environment, as a socially responsible company, we don't do some of the things. For example, we don't use that carry bag, which a lot of companies, which is not permitted, we don't use it. Many of the companies use it just to save money, at least the lesser known, the startup brands. So those small things, or treat water properly, or treat smoke properly, or to properly soundproof your generators. So these are the small things if you make sure, or not to flout the building norms when you're doing up your store, or at least to get to rent out a property which is legally allowing you to set up a business there. When we start up a company as an entrepreneur, we tend not to invest in all these small things. And I think it is very hard to raise money if these basics are not in place.
Yeah, one, I think, like Gaurav said, it's not a family firm. So clearly that is demonstrated by the fact that the kind of people that we hire. Second thing is, everyone in the senior management, for example, in our company, has an ownership in the company. So that goes beyond a certain level. So they are not just employees, they are in some stakeholders in the business. So that's a clear demonstration to both the VCs as well as to the outside world that we are a truly professionally managed company. Then, of course, on the day-to-day basis, in terms of involving investors, in terms of taking strategic decisions, for example, I think they are involved in all key decisions that get taken place. So we have a review meetings that, besides, of course, the board meetings that will happen, I think there are certain periodic and more frequent review meetings that happen with both, not just the investors, but also the independent, advisors or directors that you might have on the board, and the execution based on the plans that you would see. On the social issues, I think one of the things that we have done is, I think we are slowly moving away from use of plastic. When you're handling quick service food, there's a lot of plastic involved in packaging. And we have started moving away from use of plastic. So we are now even designing, for example, a complete meal box. That's all paper. Now, it is very difficult to take out plastic completely because of the scale that at which we are operating. But I would say that today, from, let's say, a very large dependence on plastic, in a month or two, for example, our usage of plastic will come down to almost maybe 15-20% kind of thing. So those kind of things that we are demonstrating. I think we already implemented, for example, at the Bangalore airport, I think it was news some time back, that not just us, but all vendors have now moved to even cloth bags, for example. There is no plastic used at all, in the final packaging that goes into at airport, for example. So those are the things that we are doing. But I think given the size of the company that we are, I think our social agenda has to be very limited.
Kanwal, one question, before we sort of move on to more on the Q&A part. What are your expectations from the investee post-investment? What do you see as the responsibilities? What do you see as the, what you may call par for the course from the investee?
So I think one is what we already discussed. Basically expecting a very high degree of ethics, corporate governance. Essentially, as early stage investors, we are really putting money behind a team. There is not so much business to show. There is not too much of collateral. There is not something tangible to amortize against the cash that you are bringing in. So your trust and confidence that these founders are going to, build an ethical, morally strong, socially conscious company. I think that's the fundamental thing.
Both are cash businesses.
And both are high cash businesses, which I guess a lot of retail will end up being. I think the second thing, which is one of the learnings for us as investors for a long time, is typically the entrepreneurs tend to become less communicative if things are not going well. And my strongest advice to any of you who are looking to turn entrepreneur is to over-communicate instead of less communicate, because we are literally on the same side of the table. I mean, we are shareholders, we are not debtors. And therefore, if there is a problem, if there are issues which are coming up, and these are environmental issues, these are business issues, we are certainly going to participate in finding out solutions rather than start finger pointing, because it's not going to help anyone by pointing fingers. Only place we draw the line is on ethics and moral grounds. I mean, if there is something going on of that nature, then we would rather shut the business down than try and condone something like that. So I would say one of the biggest things as an investor one looks for is transparency, is being aware of what's going on, and then participating to the best of our knowledge to help the business in whichever way we can. Not every business will succeed. We are prepared with that risk. We are prepared that businesses will end up shutting down at a certain percentage. But at least both sides tried their best. So I would say, that's the other learning that we have had as an investor for a long time.
Yeah, and just to add to that, I think, many times when investees approach us, it's a bit like, you're running, your race in your mind ends at the time of receipt of the investment. Actually, in my view, the journey begins then. Because the responsibility on the investee multiplies after receiving the money. And many times we find, in some casual conversation or some, chat over a drink, the entrepreneur sometimes betrays his perspective that, after I've gotten the money, I'm going to buy an Audi or whatever the other one is, right? And those are the entrepreneurs who we just won't touch with a barge pole. Because, it's, or a villa in Goa. But I think the point I'm trying to make here is that receipt of money is not the end of the journey of funding. It is actually the beginning of the journey. And many times we see entrepreneurs not realizing the responsibility associated with that. After all, as investors, some of it is our money, but all of it is not our money. So we are also accountable to someone to return that money with a reasonable return. And like Kanwal rightly says, there is a certain risk in this. So you're willing to digest that risk. It's just that you are not willing to take risk where it is not required. And particularly nowadays, when as an investor you take board positions and you're on the management committee and so on, you have a lot of legal risk as well, which many times the investee does not realize. And like Kanwal rightly said, eventually we are on the same side of the table once the investment is made.
If the true entrepreneurs, for example, they start business ventures because they want to change the world in some ways. I think they're extremely passionate about what they do. And I think, like Jay said, if you stay focused in what ultimately what you're planning to build. I look at VCs or PE guys are, getting onto your train ride from Bombay to Delhi, they perhaps will get down at Manmad, So, but you have to go up to Delhi, right? So I think just stay focused on what you need to do, right? So I think I think the challenge for VCs, perhaps, as I've been in that business for 20 years, is to find the right kind of entrepreneurs, who will stay focused and deliver on the, the vision that they started with. Yeah.
Sure. Just a last quick point to add. I think there's also a very valid point which Kanwal made, but I don't see that in a lot of the PEs and the VCs I've dealt with. So they don't stay for the course. They are on the other side, often. They want to come to a board meeting, an executive committee meeting, and they just want to ask questions. They don't want to give any answers. A lot of them don't want to give, I've heard of other investors, and they don't want to give answers. So there are a lot of guys out there, there are a lot of funds out there, which have a very, we are the boss, we own a certain percentage, we demand answers and results. And that's also when it leads into the fact that the promoter will not share the information, will hide stuff, or will not say the bad stuff and not look because you're not getting a solution. So I think the relationship works when it's mutually beneficial.
Absolutely.
And when both investor and investee on the same page and you realize that you're here to help each other, you also say, pardon it, shit happens. It does happen. It happens in all our business. Anyone who runs a retail or operating business, stuff happens. It's out of, you may not like it, you may not want it, but stuff happens. And to face it and, address it and address the root cause of the problem so it doesn't happen again versus, putting it under the carpet.
Great, absolutely. I think very well put, Sameer. We'll open up to a few questions. My suggestion is if you can raise your hand, and there are some mics at the back. Maybe you could just introduce yourself, and if you can tell us whom the question is directed to.
Hello. Yes, I am Sharad Binani, and my question is, I have some connected 2-3 questions, maybe they are small ones, so I'll ask. What is a typical exit period which a PE or a venture fund looks at? Maybe Mr. Singh can answer me.
That's the question, or you said yourself connected question?
Yeah. So if can you answer me that first, maybe? What is the exact kind of exit period?
I wish there was an exact exit period that works.
But there is always an exit period which is there in the mind
typically, let me answer it at a more fundamental level. Most of the early stage venture funds have a life of 10 plus 2 years. So we do look for business models where we can at least plan an exit in a 5 to 7 year horizon, so that even if there is some delay and it takes 8 or 9 years, we are still well within the overall fund life. But less than 5 for our early stage investors is impractical. More than 8 will be very difficult to manage because of the nature of the fund construct. So between 5 to 7, 5 to 8 years would be our typical approach to.
Okay. My second question is, when you say that you typically look at maybe 5 years at an exit period, and in India, if you see, typically the retail is very unorganized, and when you are looking at a business opportunity, naturally you are looking at investing into a business which is more of an unorganized sector, where you can actually end up into making a bigger returns. But my question is, when you actually look at a period of 5 years to exit, and you want that business to reach a certain scale in a period of 5 years, most of the time, being into retail, I've experienced that if you are raising up your scalability in a very small period of time, your bottom line at the end of the day gets affected. So is that you're looking at more at the top line, which is important, or is it the bottom line which is more important for a investor point of view?
Sure. So 2 parts to your question. First one is that I may have a 5-year exit horizon. The company does not have a 5-year exit horizon. So to the point that Kiran said, I may get off at Manmad from his example. So if I come in the year 3 or year 4 after the company got started, then I am exiting in year 8 or year 9, which still gives the company some ability to have built certain scale. And the company could probably continue to build out. So there may not necessarily be always a sale to somebody else. I could sell to another private equity player and exit. So there are some ways of managing the journey of the company and the venture interest. Second question was around...
My second part was, do you when we are actually scaling up the business, about the bottom line and the top line?
Sure. See, I think you will consciously sacrifice the bottom line for the initial years to propel growth. Like I said right in the beginning, if your unit economic model is sound, so if in a retail business, if you are making money at the store level, but you need to invest in backend, you need to invest in IT, you need to invest in central operations, that is fine. As long as there is a visibility of how long it will take and what happens after that. So if your unit model is not very sound and you're saying, I am going to lose money at every store that I launch for the next X number of years, that is not a sustainable model. So top line doesn't matter there. On the other hand, if your store level business model is sound and you're losing money in putting some foundational stuff in place, and because you have a visibility of how that gets amortized over time, I think that is something we are willing to work with. So we do invest in companies which are not making money. We are comfortable to stay invested for a period of time where company continues to lose money, but there should be a clear path to profitability. And the exit will only happen almost 95%, 99% of the time if you show a clear profitability. So exit is linked to profitability. Initial growth, you can sacrifice profitability not as a business model. The unit model has to still work, but as a foundational investment.
And just to add to that, if you look at retail expansion in the last 5-7 years, there was a time when many retailers, including the larger ones in India, expanded without any semblance or any focus on profitability. You know that this is my store. If I need to take 100 square feet, I will take 150 square feet. Why? Because the delta between the market price and the current price or your price of acquisition of the real estate is added to the valuation. And when you do a model like that, intuitively or even data will show that this model is doomed to fail. So as investors, you see that for sure. Once, like Kanwal rightly says, we know that the model is viable and you need resources to expand, to build the footprint or widen the footprint, the investor will willingly come forward because he knows that you're investing for the future. So I think that, yes, personally, I'm a big believer that profitability overrides everything else. But when you know that there is a path for future, which is creating, building blocks of tomorrow, then you will invest, and at that time you will compromise on your profitability.
What are you seeing with respect to the e-commerce sphere? Because we have been talking about brick and mortar, so what's happening in that area with regard to, there are US companies that have been come out of losses long back. In India, we are still
Someone did say offline.
Okay, thanks.
No, well, my opinion, and of course we can talk offline, I think most of the business models in e-commerce today are unsustainable. There is a complete lack of focus on bottom line. You're just basically trying to acquire consumers at any cost, where your product margin on a transaction is a low single digit. And then you have huge investments in marketing costs, huge investments in back-end supply chain. The model, I don't know Kanwal agrees or not, but 9 out of 10 models in e-commerce I have seen, including some of the bigger names in the business, I don't see them surviving the next 3 to 4 years.
But I just want to interrupt here. The most profitable and most utility e-commerce venture in India is the Indian Railway ticketing business. I think that has totally changed the way we travel. So I think we have a lot of hope for e-commerce. If there's no discounting, there is nothing. It's all clean commerce. And the customer benefits tremendously. He doesn't have to go to the railway station, stand in queues. He doesn't need any touts. So I think there are various ways e-commerce can go forward.
Yeah, so I think it's a long discussion. We can't have it here. But certainly, just a one-liner, we believe e-commerce is a fundamental business model which can be built. It needs to be looked at in a slightly different perspective. I completely agree with Hemu that the way some of the businesses are trying to build it may be very, overly aggressive and overly short-term focused. But certainly, the fundamental reason why e-commerce should and can be built, and IRCT is a great example, is so we are investors in e-commerce, hopefully responsible investors in e-commerce, but we have 5 investments. And we do believe that in a 10-year horizon, e-commerce is here to stay and should be able to see some interesting businesses. But there are underlying things which we need an hour to discuss. So.